Opendoor is one of the most popular stocks in the markets today. And over the last month, it's up over 97%. The stock's popularity is fueling an interest among retail stock investors who want to create a sort of momentum, creating a boom in the share price, trying to send it to the moon, as they say. But investors also want to know, what do I think about the company in terms of fundamental performance, revenue, profits, on a valuation, discounting the cash flows? What is the intrinsic value and how does it compare with the current market price? So I'll do all of that here in this video, understandably noting that these aren't all of the factors that's driving price movement for this stock in particular, but still it helps to conduct this kind of fundamental analysis to compare with other factors influencing the share price.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the company's revenue growth has been volatile, soaring to $15.6 billion in 2022. Of course, that's when the housing market was booming in the United States. And since then, the housing market has been in a sort of stalemate, with sellers refusing to lower prices to sell and also keeping their homes because they locked in very low mortgage rates, and the elevated prices are failing to bring in new home buyers because of the unaffordability. And so the company's revenue fell to $5.2 billion in the most recent trailing 12-month period. And the management team expects more difficult times in the upcoming quarters as the economy is slowing down. Increasing trade barriers are making it more uncertain for people to go out and make a long-term decision like buying a home. Mortgage rates remain elevated, but are on the way down. And that's been really great news for Opendoor, is that lower interest rates and lower mortgage rates makes it more attractive and more affordable for home buyers to jump into the market. It also could unlock some sellers to let go of their homes and their mortgage rates because they can get a new mortgage that's relatively closer to the existing mortgage rates they have, and the difference between what they have locked in and what they can get if they buy a new home and trade down or trade up is not that big. And so that's creating a lot of enthusiasm for Opendoor stock. As the company is preparing for more difficult times, it's making lower bids, right? If you are unaware, Opendoor buys and sells homes. It offers to buy your home if you're interested in selling your home and you don't want to go through that whole process, hiring a real estate agent, listing your home for sale, all of that stuff. If you just want to make a direct sale to a company like Opendoor, they'll give you an offer and you can make your sale and move on with your life. You don't have to go through that whole process. Well, Opendoor needs to make a profit, right? So it lowballs homeowners and then resells their homes at higher prices. And it's even making wider bids now. It's even widening that range because it's expecting more risk in the near term. So it's offering even lower prices, and it expects to have fewer purchases. As a result, it understands that home sellers are not going to be very interested in selling their homes if they're offering them lower prices. The management knows that. They are okay with that. They'd rather have fewer homes at lower prices rather than more homes at higher prices with more risk that they won't be able to resell them at a high enough price to make a profit on the transaction. So as you might imagine, this business model is very capital intensive. Homes are hundreds of thousands of dollars and sometimes over $1 million. And having the capital to invest, hold those, resell those, capital intensive business. More recently, though, Opendoor is working with real estate agents and sending them referrals and earning fees based on that business model. And that could generate more lucrative, higher margin, less capital intensive businesses that can help improve the company's profit metrics. So you can see the operating cash flow to sales is volatile. This depends on the number of homes it sells and the number of homes it buys in the quarter. If it buys more homes than it sells, then the cash flow will understandably be negative. And if it sells more homes than it buys, understandably the cash flow will likely be positive, of course, depending on the price points of the homes that it's selling. So it's not consistently positive cash flow, and it's also not consistently positive on the return on invested capital. Still early days, this business needs more scale and the business needs more refinement before it's generating sufficient profitability. Also, as the company grows larger, the cost of capital will likely decrease, thereby improving the business model that much further. If the company can raise capital at lower interest rates, at lower costs of equity, it will help finance the purchase of homes at lower cost of financing. So now let's look at valuation. And of course, I calculated a discounted cash flow valuation model for Opendoor. This valuation model is what identified to me this stock as a buy way back in February. I rated Opendoor stock a buy before most people were even paying attention to this company. I had it rated as a buy all the way back in February. I downgraded the stock to a hold once the valuation had soared above, I believe, $6 or $7 a share is around the time when I downgraded it to a hold because the valuation had gotten so expensive compared to my fair value calculation. As you can see here, that remains to be the case. I calculated an intrinsic value per share of $2.80 for Opendoor. The current market price at $8 shows an overvaluation based on my valuation model. Now, I understand investors in Opendoor stock are not considering valuation and fundamentals like revenue growth and profitability, etc. They're not following traditional valuation metrics with this stock. This is one of those popular stocks. This is for momentum stock investors, for investors that want to get on board here and hope that the share price goes from $8 to $200 or $1,000. They're hoping for a huge, magnificent gain here. This is not a value stock investment. This is just one of those popularity type investments that they hope to catch many more investors on board and drive the share price higher and sell it to somebody else and get out and make a handsome profit in that case. But just looking at the valuation methodology that I utilize and I incorporate into my decision making, this stock does not look like a buy. I have it rated as a hold, and I will reiterate that hold rating for this company. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.